we're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers are very clear.
Welcome to the Cryptoteacher. And guys, I come back with that video just to make you think. And we had the Fed's Jerome Powell in the house. And Jerome Powell is definitely my guy. Now, guys, as he states, he's going to allow your rates to keep rising. As we see, when it comes to tech, it's killing those stocks. But also in crypto, we know a lot of that liquidity is going to start shrinking if these yields keep rising. Now, we know that when it comes to the stock market and crypto market, we know Janet Yellen's money. We know the stimulus package is coming. So it's going to be a short-term injection, but after that, guys, it's going to be some pain. Now, Jerome Powell stated they're not going to increase the treasuries and mortgage-backed securities, so they're going to keep it at $120 billion. And then also he stated that they're going to control inflation. But we know that's not correct. We can go to our grocery stores, we can shop. We see prices are going up. Housing is going up because of wood prices. Steel is going up. We see all these commodity prices are going sky high that the Fed does not include. If they included your grocery bill, guys, we would be way over 2%. But we know that's what they like to use. Remember, guys, the New World Order creates the problem, waits for the reaction, and they're going to come in with the solution. So I'm going to tell you what's going to happen before it happens. They're going to allow inflation to get out of control. They're going to wait for the people to start screaming for the government to help. And what's coming next? That's right, guys, cryptocurrencies. Cryptocurrencies airdrop to you, going to tell you what to buy, how to buy it, and when to buy it. Programmable money. We know that is the New World Order's plan. The fourth industrial revolution. Robots, algorithms, drones. Take humanity out the economy, put the robots in. Because we know when it comes to the New World Order, everything is planned out. Enjoy the rest of the video.
The $900 billion the Congress approved around Christmas, and then this $1.9 trillion package Congress is looking at right now, that's some serious spending. And the market has been pushing up longer-term interest rates, maybe because it seems to anticipate an unwelcome increase in inflation. Is the market wrong?
Well, is the market wrong? That's a pretty broad question, I would say. Maybe to be a little more specific, let me talk about the sort of market pricing, I think is what you're really asking about. So in terms of the bond market, so you're right, bond market rates moved up. And as far as that is concerned, a number of factors are factored into it. But from our perspective, we monitor a broad range of financial conditions, and we think that we're a long way from our goals. We think it's important that financial conditions support the achievement of those goals. And I would be concerned by disorderly conditions in markets or a persistent tightening in financial conditions that threatens the achievement of our goals. I would be concerned if those things were to happen. In terms of the other question tends to be markets reflect an estimate of when we would raise interest rates. And so let me talk about that. That's the other question. So the question is, what would it take for us to want to raise interest rates? Right now, our policy rate is effectively at zero. So we have a new framework, and we're strongly committed to implementing that framework, and we have guidance out to implement that framework. As I mentioned, with rising vaccination and other things happening, fiscal policy support, there's good reason to think that the outlook is becoming more positive at the margin. And in coming months, we could see spending and job creation picking up. So let me talk about the guidance. And by the way, the guidance is always it's outcome based. It's not date based. So we never say, hey, we're going to do this in 18 months or 24 months. It's always when these conditions are fulfilled. So for asset purchases, as you're aware, we say that they'll continue at least at the current level until we achieve substantial further progress toward our goals. That's actual progress, not forecast progress. And as I mentioned, there's good reason to think we'll begin to make more progress soon. But even if that happens, as now seems likely, it will take some time to achieve substantial further progress. For interest rates, to raise interest rates above zero, very simply, we said we'd want to see labor market conditions consistent with our assessment of maximum employment, and that means all of the things that we talked about. We'd want to see inflation sustainably at 2%, and we want to be on track to have inflation run moderately above 2%. So these are highly desirable outcomes that would represent an economy that's very far along the road to recovery. And there's just a lot of ground to cover before we get to that. The last thing I'll say is this, and I want to be clear about this. If we do see, as I mentioned, if we do see what we believe is likely a transitory increase in inflation, where longer-term inflation expectations are broadly stable at levels consistent with our framework and goals, I expect that we will be patient.
What I'm wondering is, the market now believes the Fed will raise rates earlier and faster than it thought a week ago. Are you saying that's consistent with your outcome-based policy guidance and with your new framework?
It's going to depend entirely on the path of the economy. So I laid out the conditions upon which we would consider raising interest rates, and that's labor market conditions that are consistent with maximum employment, which is, that's a big thing to get to, and it will take some time to get there, right? Inflation sustainably at 2% and inflation on track to run moderately above 2% for some time. So those are the conditions. When they arrive, we will consider raising interest rates. We're not intending to raise interest rates until we see those conditions fulfilled. And so that it's really the timing will depend entirely on the fulfillment of those conditions. And as I said again, if I've told you that we think we're likely to see inflation move up during the course of this year through really two things. First, the base effects I mentioned, but also just kind of reopening effects where businesses will be potentially hit by a lot of demand as the economy recovers, which is a good thing. But you could see bottlenecks, you could see prices moving up. We're inclined to see those as transient, and there's a difference between a one-time surge in prices and ongoing inflation. Ongoing inflation, where prices go up year after year after year, tends to happen when people's psychology becomes that they believe that's what will happen, and they have no faith that the central bank, frankly, will prevent that from happening. So, as I've said, the key thing is to keep longer run inflation expectations anchored at 2%. If that happens, then a transient increase in inflation will not affect inflation over a longer period. And we intend to use our tools to keep inflation expectations anchored at 2%, which gives us the ability to do all of the things we do when the economy is weak.
Dollars per month in Treasury and mortgage securities. You've been saying for the past year that your asset purchases are designed to support market functioning. Have you seen anything in the Treasury market that suggests a need to lengthen the maturity profile of your purchases?
So we think our current policy stance is appropriate. As I mentioned, the federal funds rate is at the effective lower bound, which is our technical name for zero or close to zero. We provided really strong guidance about the conditions we need to see before we considered raising it. We're buying $120 billion in treasuries and mortgage-backed securities across the curve, and we'll continue at least at that pace until we see substantial progress toward our goals. Financial conditions are highly accommodative, and that's appropriate given the ground that the economy has to cover. It's always the case that if conditions do change materially, the committee is prepared to use the tools that it has to foster achievement of its goals.
Well, and if there were some kind of rate move that you felt represented a threat to your outlook, what would you do to address it?
Well, that's a sort of hypothetical situation. We would use our tools. It's hard to say in the abstract, but we would use our tools as appropriate to foster the achievement of our goals.
There's been some discussion in recent days. It's gotten a lot of attention. The idea of selling bills or letting bills run off of your portfolio to address a collateral squeeze in money markets. Is that something you think needs to be considered at this time?
As I said, I wouldn't want to speculate. Really, I'll just say we'll if conditions do change materially, we'll be prepared to use our tools in whatever way is appropriate at time to foster the achievement of our goals. So many people, particularly people who are now entering the job market, will not have lived through high inflation, and high inflation is a very bad state of affairs, and it hurts people the most on fixed incomes and lower incomes who have less wealth to draw upon. So inflation was very high when I was in college and coming into the job market. So it's really not something we want. But I would say, at the Fed, we are well aware of the history and how it happened, and not going to allow it to happen again. It was a situation where the Fed didn't step in when it should have, when inflation pressures were building. Not at all the current situation. Inflation is currently running below 2%. It's running at 1.5%. But we're very mindful of what happened in really the 1960s and 1970s, and determined not to repeat that mistake. But you have to differentiate, though, between one-time price effects, such as things that happen around the reopening of an economy, not something we have much experience with, and just the sort of, when I say base effects, it's a technical term. You look through that; it's not really signaling anything about inflation. So, I mean, we're very mindful, and I think it's a constructive thing for people to point out potential risks. It's always constructive. I always want to hear that. But I do think it's more likely that what happens in the next year or so is going to amount to prices moving up, but not staying up, and certainly not staying up to the point where they would move inflation expectations materially above 2%. That would take, the public would have to come to believe that that's the new policy, that's the new reality. And I really don't think that, a couple of quarters of prices, or even more than that, but prices being above 2% would change the psychology, particularly in a world where inflation has been the problem for the last decade in all of the major advanced economy countries. They've been facing low inflation because of these global disinflationary pressures, which haven't gone away, and they're not going to go away overnight.